Right, let's get into it. Today we're going to get into the SPAC. The new SPAC that will grace its presence on the ASX. What is a SPAC, you may ask? We're going to go into it. This SPAC is Metals Acquisition Corp. Now, MAC, you would have seen taking the headlines of recent in the AFR and everything. We keep mentioning the AFR, lucky them. But names associated with as Nev Power and Bill Beament, and the CEO is Mick McMullen, who was on the board with developers, recently left. And this SPAC, MAC, rhymes, is purchasing or hoping to purchase, it's been going on for a while now, the CSA copper mine in Cobar, purchasing it from Glencore. So we're going to go into in detail what these SPACs are, why they're different to a normal ASX company you see every day, and how it works with this bit of an all-star lineup they got. So, boys, let's get into it. First, the definition. What is a SPAC?
Yeah, let's get into it. So a SPAC is much more of a US phenomenon. We didn't really get any down here for a few different reasons. And to me, I'm not sure about you guys, but SPACs sort of epitomise the heyday of 2021. These things were just flying. So
what does it stand for?
Special Purpose Acquisition
Corp. Is it Corp?
Company.
Company.
Yep.
Special Purpose Acquisition Company.
Like a blank check company, right?
Yeah, so that they're also known as blank check companies, and we'll explain why shortly. So essentially how it works is you get sponsors who are the management of this SPAC, and they create it. They'll attract investors usually through their sort of brand name. They might be famous people. So in the past, Bill Ackman, a very famous hedge fund manager, Chamath Palihapitiya, someone famous in tech circles, they were very notable for the amount of SPACs that they churned out in 2021. So essentially what you have once the investors have been attracted is a company, no operations, just a pile of money. And these shares to the investors are usually issued at $10. So this company then has a mandate to acquire something. Now it's usually a company that's private that it'll merge with, but as in the case that we're going to talk about today, it can be an asset as well that they decide to merge with. So
sometimes it's even a public company, I notice.
Yeah, it can be. The most common the most common purpose was for a private company, so that this private company could become public without the scrutiny that the SEC and other organisations around the world would put on companies in that going public process.
So SEC is the American equivalent of ASIC.
Yeah. That's right.
And so in its infancy, you've got a company with a blank, when you say a blank check with a lot of cash, their purpose is to buy either a company or an asset, and they have a bit of an all-star lineup of people with, credible and successful track records on, like Bill Beament and Nev Power from Fortescue Metals. So that was the all-star lineup.
You trust the people to find a deal. That's the premise, right?
Yeah, and to be clear, those guys weren't actually the sponsors in this case, but we'll get into that in greater detail later. So a couple other things to note is that the most common time frame is 2 years. So the sponsors have 2 years to merge or find a company to do a deal with. If not, the shareholders can get their money back, and they will get their money back at the end of 2 years.
And they get it back at the exact same price that they dipped in, right?
That's
so
it.
You get the
$10 a share.
And is that why, when there was zero or negative interest rates, the SPAC was a lot more popular because the time value of your money was from a risk-free angle. Well, it wasn't material, right?
Exactly.
So you got a free option on a good deal, and
so you can get your money back in a couple years' time at the same price you put it in for. But in the meantime, guaranteed. But in the meantime, these things are tradable. And during 2021, just on the excitement and on the rumours of a potential deal, the share prices would go flying. So it was a crazy, crazy time there. And there's a few other things we should mention. Shareholders vote on the proposed deal. So in the case of Metals Acquisition Corp, that vote is happening next month. And at that point, they can either not go ahead with it, get their money back, or they can agree, and then the thing gets merged, gets a new name, and so on.
It's interesting, JD. There's a few data providers out there that talk a fair bit about the returns of SPACs over periods of time. And if you like, we'll bring up a chart now, but it basically shows the median return in a de-SPAC transaction by percentage return to shareholders by industry, and you can see that for the longest period of time, the median return from one of these SPAC transactions is substantially negative. So they've got a bit of a bad reputation. They had a heyday in the 2021, but they're definitely not. There's definitely some question marks on the ability of these transactions to actually generate outsized returns.
Yeah, and that lack of regulator scrutiny has at times been like the reason that some people will say SPAC isn't the way you should go public. It's a way for, quote unquote, not as up to scratch companies to go public. And if you just sort of glance your eyes over the biggest SPACs of the last couple of years, Virgin Galactic's one, I think they're in bankruptcy as of last week. Nikola is another electric vehicle maker. They went from a share price high of about $65, found to be a fraud, and they're trading at about 70 cents now. So
are those that chart there, Trav? Is that all American companies? Have there been any instances of SPACs in Australia?
Well, they're a function of the listing rules on the exchange that they're on. So where these have grown in prominence is the New York Stock Exchange because of the listing rule dynamics that sort of facilitate these types of transactions, and that's why even a mining SPAC ended up on the New York Stock Exchange because even though they're sort of Australian people headlining it and ultimately was an Australian asset deal, it was more a function of the listing rules on that exchange.
Yeah, so I think that sort of wraps up what really a SPAC is, and we can move into why these guys are in the news lately. So they've raised or got agreements to raise US $140 million, and most of the figures we'll note today are in US dollars, given it's an American company. So they've got that from Cornerstone Investors. Now that is what they call a PIPE, which is essentially a placement if you're an Aussie investor. That's what you equate that term to. And this has been the biggest PIPE in the last 18 months. So that really just shows the fall from grace that SPACs have had lately.
Well, the challenge is in actually getting these SPAC transactions away, right? Because you need these PIPE investors to come in and make it all work because the redemptions on the initial cash is so large.
100%. So like we said before, shareholders will now vote on June 5th to convert the business into a copper company. And they will act as a platform for further purchases from a SPAC after completing marathon efforts to raise the money to buy Glencore's CSA mine near Cobar. So the last thing they'll need here is support from 2/3 of shareholders at that June 5th meeting.
Okay, so and these shareholders are Americans? This company has come from America and they're spinning out this SPAC in Australia? They're
not necessarily American shareholders. Like you can be an investor in a New York Stock Exchange listed company as someone domiciled in other parts of the world too.
And they were trying to attract institutions on the sort of premise, knowing that the company would in turn have an ASX listing down the track.
Yep. And who are the big shareholders? Do they disclose it? I'm sure they do in the prospectus.
Yeah, they do. I think I'll touch on that one a bit further down, Matty.
No worries. Sorry to butt in. This is, as I said, this is Finance 101 for you guys. So I'll be asking plenty of questions to clarify it for the money miners and myself.
Well, mate, it's a pretty complicated one, even though you call it Finance 101. These transactions, they're not commonplace in Australia. You never see them. You hear about them in the news because they were a function of the American market. But I think there'll be a lot of people asking the same questions as you are today, and the same questions JD and I were asking each other this morning.
Yeah, so I reckon we can get into the transaction a bit now. So they're buying the CSA copper mine. Now this is in country New South Wales.
Cobar.
That's it. And Glencore
Shout out to Peter Finn if you're listening from Cobar.
Glencore have been looking to sell this one for quite a few years. How long have you guys heard rumours for this one on?
Well, IGO I think it was announced at a conference or something. IGO were planning to buy it, and
they were on the box seat just last year. So a bit of background: it's looking to produce between 40 and 46,000 tonnes of copper plus silver byproduct credits over a mine life that currently sits at roughly 20 years. So
highest grade copper mine in Australia. I'm pretty sure DeGrussa was higher. It's the highest grade copper mine and one of, I think on their website it said the 4th highest grade copper mine in the world.
It's pretty deep, Matty.
Very deep. One of the deep. It's not as their website said 1,750 metres, not as deep as Gwalia, but they've got a shaft, so they don't. It's not decline travel. There's a hoisting system,
Gotcha.
But very deep and very hot in country New South Wales. And amplified by the fact it's so deep.
It's been mined for quite a while. Glencore picked it up in 99, I think, actually out of administration, I think. So getting into the price tag, US 1.1 billion. So the deal has been recut quite a bit over the past year or almost 2 years now, but that dollar figure has stayed pretty similar, hasn't it? It's just really the terms of that have been changed.
Glencore definitely have a bit of a reputation for being quite stubborn on value. So it doesn't surprise me that the 1.1 billion headline number has stayed the same. But
I think it's served them well.
Yeah.
There's a lot of interest, but there's a lot of contingent payments attached with this now, the updated deal.
Yeah, so let's get into all the different aspects. Like we said, 1.1 billion US plus a 1.5% copper royalty that Glencore will take. Glencore's also actually going to be buying all the copper and silver that is produced for the lifetime of the mine.
So they've secured the life of mine offtake as well as the sale.
They have,
That's
yes.
right.
Yeah, right.
Which I think is what they really care about, right?
That in addition to the royalty. So it's all just a big pool swimming back to Glencore.
That's it. So 775 million is in cash. Now this can be scaled up to 875 million depending on that pipe. So think placement, which is going ahead at the moment. 75 million deferred to be paid out on half the proceeds of any future raising. So I think you could speculate that when they list on the ASX, up to $75 million, depending on how much they raise. We're going straight to Glencore. Then a couple contingent payments. So 75 million contingent on copper being greater than $4.25 a pound for 18 continuous months, and another 75 contingent on copper being greater than $4.50 a pound for 24 continuous months. Plus obviously that 1.5% royalty.
Really gambling on the copper price going up.
Yeah, well, I mean, you look at that, and this is the recut terms, right? It's not the terms when it was first announced for the acquisition. This is what's sort of been renegotiated, probably to just help get the whole deal over the line, right? And
there's additionally 100 million in common equity as well that Glencore get.
Yeah. So the upfront component from a cash perspective is that minimum of US 775. And the rest, you look at it as deferred and contingent. They're giving away some of the upside by having these copper price contingent pieces, and the royalty as well sort of gives away some of that upside. From an
absolutely. I think it'll be quite interesting to sort of dig into how the deal's changed. So we started hearing about this mid-2021. It was ongoing for quite a while, but let's break down how that initial deal looked to how it looks now.
Yeah, well, I think the interesting part to me is maybe not what the price tag change has been, but more how they're going to fund it. How has that changed?
It's $1 billion.
Yeah,
1.1 US.
Yeah, totally. It's a juicy, big number, right? So,
and ultimately, I think working down to how that impacts the equity shareholders will be quite interesting, won't it?
Yeah, because I mean, this deal was struck in an environment where SPACs probably had a bit more capability of actually funding deals, but in the intervening time, redemption rates on SPACs are so large that getting these de-SPAC transactions over the line is a lot more difficult. You need you need other sources of equity and some innovative sources of equity to make it all happen. And I think that's what I want to talk about here. So, let's look at the funding sources for Metals Acquisition Corp. They've got a senior debt facility, or they've got senior debt facilities. There's 3 of them that they talk about in their latest prospectus on the SEC, and they add up to US $258 million. Now that's down from what was in first announcement signaled to be $375 million. There's a mezzanine finance facility, and that's US $135 million, down from $175.
And I think for those wondering what mezzanine really means is in the capital structure, it just sits below senior debt. So if things in a company sort of go belly up, The senior debt holders have the first rights to the assets of the company. Mezzanine come behind them, and
You
then
pay a higher interest rate on it.
exactly. So higher interest rate, and at the bottom of that pile is generally equity holders.
And why are they down, Trav? Those facilities, is that being used for this? Or
Well, you can probably question like how binding some of the original debt facilities were. That was probably conditional on the equity all coming together, and I think the equity part coming together has looked more challenging. So they've renegotiated a lower upfront cash requirement, so it's now that only $775. So I think all of these debt pieces slide down a bit. You still look at it and you think there's a good chunk of debt in there, and I think we'll get to that.
So a couple of streams in there as well, wasn't there?
Yeah, Silver Stream has sort of stayed the same, but it's about US 75 to 90 million.
And for those wondering, silver, copper streams, what these things are is the company is giving money upfront for a right to purchase a percentage of the production going forward, and that right to purchase is at usually a very small percentage of what the actual price of that commodity sits at.
How does a stream sort of differ from a royalty, JD?
So the key differentiators between a stream and a royalty is somebody who gets a royalty isn't having to pay, even though it's only a small amount here, in this case 4% of what the actual price of that commodity is. That's not the case with a royalty, you're just getting it. And often there's negotiated timeframes for a streaming agreement. So in these cases, they've made that agreement to have the right to purchase the commodity for 20 years.
Gotcha. Yeah, so like interesting, right? But both of them effectively are kind of you're giving away some of the equity upside in exchange for money up front. Is that the best way to think about it?
Yeah, they're sort of nuanced ways to not have to dilute or take on as much debt, essentially.
Yeah, not non-dilutive from a shareholder perspective, but certainly dilutive from what's actually happening to the revenue, right?
100%.
Yeah. So yeah, there's the silver stream we talked about, and there's also a copper stream. This is new; it wasn't in the original docs, but it's a copper stream tied to a redemption backstop facility to provide up to $75 million.
So that copper stream is only put in place if the redemptions are greater than anticipated for the company, right?
Yeah, that's right. So yeah, the stepping back a bit, Metals Acquisition Corp is currently a blank check company with a bunch of cash, and the people who put that cash in have the right to redeem it. In recent history, those redemptions have been really, really high, like thinking 95% and above. Metals Acquisition Corp have done their analysis assuming a certain redemption rate, and if that certain redemption rate is higher than they imagine, then they're going to have to use this copper stream redemption backstop facility. Then there's also some of the equity is being committed by these financiers, Sprott, who's actually providing the MES facility, they're tipping in $15 million for equity, and Azisco, who's providing the copper streaming and backstop facility, they're chipping in $25 million of equity there as well. There's pipe equity, which that placement piece of new equity holders, which we talked about, their subscription agreements in place. And then they're also going to have to rely on whatever cash is not redeemed, so left in the trust for the purposes of actually funding the transaction as well.
So how much is the shortfall, Trav, based on all that for this $1.1 billion price tag?
Considerable. It really all depends on what their existing shareholders choose to do come this upcoming vote. These shareholders have the right to redeem their cash at $10 per share, or they can choose to follow the company and become a shareholder and participate in the equity upside that pertains to these Metals Acquisition Corp shares over time instead. So it's hard to predict, right? Unless you have really good insight on what that redemption rate is going to be. You could do some thumbsuck analysis based on historic redemption rates, and MAC themselves do some of that analysis in their latest prospectus too. And then top it off with the fact that Glencore, they've agreed to accept more equity themselves, take some back-ended payment and copper price-related contingent payments. All of that is just to reduce that upfront consideration piece, but maintain headline value.
God, how many royalties would Glencore have around the world with all their acquisitions and everything? They would have a massive stream of them, wouldn't they? Things like this. This would be one of many, I should.
Well, yeah, there will be plenty around. There's no doubt about it, Matty.
So with all that, streaming, royalties, debt facilities, I think it'd be really interesting to sort of dig into what it actually means for equity investors. And I think that's really important because this company is planning to list on the ASX, sooner or later. I think there's a good chance we'll see it listed here. And the rumors have been of a pretty huge, $500 million IPO on the ASX in quite a few months' time. So let's sort of break down what those sort of equity investors will be buying into.
Well, and just to clarify before you get into that 500 mil IPO and the $150 million pipe, how are they linked? Is that the IPO in Australia a whole new set of investors?
Yep. The pipe is something that's agreed. The ASX listing is something that's still hypothetical at the moment down the track. This vote will be the sort of tell-all. And
this IPO will raise $500 million cash.
Rumoured to.
This is all speculative. The ASX piece is all, there's no real good data on that yet, but this is just what's rumoured in the media.
The company has actually, in the 700-page prospectus that we enjoyably read today, they do have a few.
But you boys did.
They have a few lines pertaining to their intentions to list on the ASX and some figures around it. There is one point where they mentioned the figure $225 million US to potentially come in the door through a future ASX listing. So
there you go. That's insightful.
But the media's obviously pulled that 500 from somewhere. That seems to be that headline number that's going around, 500 odd. So yes, we'll wait and see.
Mm-hmm. Yeah, and like coming back to your point, JD, like we're talking about the equity holders in MAC. What do they get? And we know from Finance 101 that the equity gets whatever's left at the end of the day when you're servicing all of your other financing costs. So put aside the operational performance of CSA, and let's just look at what once you get some profit from that, what sort of interest do we have to service or royalty payments do we have to make and all of that sort of stuff. I think that's an important thing to talk about because whatever's left over once you do all that is actually what's available for equity holders. So starting with the senior debt facilities, there's 3 of them. Facilities A and B add up to US $230 million. And the interest rate on them is SOFR plus a 3% margin.
And a lot of people are probably wondering what on earth SOFR is. So I think when Trav and I were in uni, the benchmark that was always used was LIBOR, but now it's commonly used as SOFR, and it stands for Secured Overnight Financing Rate. And just for reference, at the moment, that sits at about what the US Fed funds rate sits at. So that's a bit over 5%. So given in mind, Trav, the number you just mentioned for what it sits is SOFR plus 3%. That's at over 8% interest rate for the senior debt, which is the, as you'd expect, lowest interest paying debt.
Yep. And there's also a facility B for Penn to be US $28 million. It's not yet committed, but that piece there is required to guarantee some of the requirements for rehab at CSA.
Yeah, now let's get into the mezzanine facility. That's an interesting one with some pretty juicy looking interest rates on it, isn't it?
Yeah, absolutely. And it's not an insignificant quantum, right? So this mezzanine facility is US $135 million. Sprott is the lender, and the price tag, the interest payment on this mezz facility is SOFR plus 8 to 12%. It depends on the copper price in the period on what margin it's going to be there, the 8 to 12%.
Geez, so what's that potentially?
13 to 17%.
13% per annum.
13 to 17%. Yeah, 13 to 17% on the mezz facility, US 135. Yeah.
And that facility, Sprott take the interest for that. Is that how that works?
Absolutely. Yeah. Sprott give the US 135 up front. They get the interest payment and they'll expect principal repayment as well in due course. It is worth mentioning, right, that part of the equity piece that's all come together, you see Sprott in there. They've agreed to buy US $15 million of the equity in MAC. And I look at that and I sort of think, what's that $15 million of equity compared to that juicy interest rate on the debt, right? It's like less than 1 year's worth of interest payments on that debt. And plus they get some warrants that have a nice 5-year expiry date on them as well. So, the equity I think is relatively a small part of the equation for Sprott when you consider that debt.
Absolutely. And I think the same goes for Cisco. So we'll get into the silver stream now. US $75 million that Cisco is giving to Metals Acquisition Corp. And in turn, what they get is the right to buy 90% of the silver that's produced from the mine. And that right to buy is at 4%. So they only have to pay 4% of what the going price for silver is to get it. So if you look backwards and sort of put this over what the mine produced over the past couple of years, say in 2019, 430,000 ounces of silver, Osisko would have then had to pay $400,000 and in turn made about $11 million from what that silver was actually worth.
That's not the last of sort of Osisko's role in the financing this consideration. They've also agreed to this redemption backstop facility, which is tied to a copper stream. Remember, this is the new piece that I wasn't sort of talked about on the first deal and has sort of come into the things. And I sort of look at this and think, you want to be streaming the copper? The copper is the selling point here. But there is definitely this copper stream as part of the revised deal. So Osisko, they'll make available US $100 million if there is a shortfall in funds available for MAC as a result of greater than expected redemptions. And that will be US $75 million for a copper stream and $25 million equity subscription. So the two are tied together, the equity participation and the copper stream available.
So the copper stream, the terms are similar, but in some aspects a bit different to what the silver is. So they'll only get the opportunity to buy between 2 and 5% of the total payable copper produced at the mine, depending on how many years after the closing of this deal it is. And similar to the silver stream, they'll only have to pay 4% of what the going rate of copper is at the time of delivery. So those numbers end up being similar to silver. Over the past couple of years, they would have been paying $400,000 for the equivalent of about $11 million worth of copper.
Geez, they'll struggle to find an accountant that will want to work for them to sort all this shit out. Far out. This is this on the absolute high end of complicated deals and offtake and royalty arrangements?
Yep.
It could be a bit more
straightforward. Thank God for
straightforward.
that, because I was thinking if this is simple.
Well, I think that the complexity speaks to the challenges of funding the acquisition price. Yeah, there's a lot of sort of streaming and royalty and contingent and deferred finance. It all comes together just to get the cash to fund the acquisition price.
And and it seems like everything was hinging on to get all these Sprott and everyone, Cisco and all that on board. They needed to have those contingent considerations to get them all in. So everything, the buying, the offtake, it's all like, God, talk about it. Yeah. We need a family tree here.
Well, it looks like, like Osisko and Sprott, they're getting pretty good sort of deals in terms of, streaming deals or lending deals, and those the way that MAC have negotiated their arrangements with them, it's included this equity participation as well. So I think you've got to look at their equity participation in the context of their roles in actually financing the acquisition too.
I think we can just fly through the last of those terms. So as we mentioned, there was the 1.5% royalty going to Glencore, deferred payment up to $75 million of any future equity raisings that the company does, and then the contingent payments that total $150 million US, as we mentioned before.
So all of those, I guess, are liabilities that you've got to be able to fund before anything goes to equity.
Yeah. So who's getting the best deal there? Sprott's interest rate looks pretty good. Obviously, Glencore get the massive sale price plus the royalty. So who's in the best seat?
Tell me where the copper price goes and I can tell you
the
who gets the best deal. Yeah.
So Glencore get a pretty good deal, I reckon, but that's my hot take.
Absolutely. So let's get into the sort of operating cash flow. I think that's kind of interesting to see how that plays out in future periods.
Well, grade is king. So if the copper price appreciates to these levels that people are talking about, and you've got one of the highest grade copper mines in the world, the margins are very, very juicy.
Yeah, if you're
something
sort of
like this.
Wondering, MAC reported that CSA mine had cash costs of $1.71 a pound last year.
And I guess like we've just talked about all of these, high interest, what we think are sort of high interest obligations and streaming and royalties and all the rest that have to be serviced by the cash flows of CSA. And of course the equity is not entitled to that element. So it just leads you to question, like who's actually participating in the equity here? Who's buying the pipe ultimately, or the placement to get this whole deal away. And it's all sort of contingent on that. And we saw them, announce that $140 million in pipe subscriptions. Well, we spoke about Sprott and Zisco, and it's sort of clear to see that their equity participation is tied to these good deals that they're getting from a streaming and financing perspective. Like, so who else? Who else is participating, right? Well, like disclosed within the prospectus itself, it actually says that there is an agreement for certain cornerstone investors to be transferred founder shares as part of their investment. So I think, like, in addition to that, I imagine MAC are also counting on a decent proportion of the cash that's in the trust right now not to be redeemed. And we in the headlines of the deal and everything like that, we also read that the MAC directors, they're tipping into their pockets to get the pipe over the line as well.
So I think that kind of flows into what the incentive structures look like. And I think that's an interesting discussion because, like we sort of said, the job of management or the sponsors is to get this deal to happen. And they are incentivized by what's called a promote. So upon the execution of the deal, that promote can end up being about 20% of the shares on issue of this company. And that can be a pretty healthy amount depending on the size of the overall company. So
does that tie into that point you just made, Trav, with the founding shareholders can be transferred shares? Is that like transfer mean given or?
Yeah. Yep.
Yes, and that's based on what JD says is the success fee, you could say, for completing an acquisition. So it's like being a corporate advisor advising an ASX company on a raise or a merger. They have a fee that they're given if you successfully complete that. Is that sort of a parallel comparison to how these SPACs work?
The prospectus has some wording about the value of those. The shares that go to the sponsor, they're ultimately worth a fair bit if the deal occurs, and they're worth nothing if no deal occurs. So this sponsor, the success fee, you could think of it like that.
Yeah. So this sponsor, as we've said, these SPACs come around by getting an all-star lineup, people with a business execution reputation, successful companies, and they say, right, we will give you shares if you find us an asset. And this asset to speak of is CSA.
Yeah, but there are some constraints. Obviously, they're not getting paid cash; they're getting paid shares. And some of those constraints may be, I think, in the case you can read here, that they can't sell within the immediate year post the deal wrapping up.
Mm-hmm. Yeah. So, like, and we keep talking about this sponsor. I think it's important to kind of clarify, like, what a sponsor is in the context of a SPAC. JD.
Yeah, absolutely. So the sponsor during 2021 was really the key attraction. Those names that I mentioned, Ackman and Chamath, they really attracted a lot of people, and they're just sort of leveraging their reputation. People think these guys can get a deal done, so I'll back them. Like Trav touched on earlier, the opportunity cost was so low. You can get your $10 back in 24 months' time, and when interest rates are zero, that looks like quite a good deal. And obviously how they get compensated is getting a good slice of that combined business once the deal is completed.
For MAC, the sponsor for Metals Acquisition Corp is a Cayman entity called Green Mountain Metals, LLC. And I want to talk through some things that I can deduce by unpacking the prospectus lodged with the SEC a few days ago.
First Cayman Islands company we've talked about. This should be pretty interesting, Trav. We're looking forward to getting in the weeds here.
So upon the business combination being approved, so that's that vote next month, the sponsor will end up with about 6.5 million shares in MAC, and that equates to about between 11 and 20% of the pro forma company, depending on the redemptions. At the $10 per share price tag, it's just short of about US $70 million. And I want to read a paragraph in the prospectus that puts that sponsor piece, I think, into context, and especially in respect of the incentives at play here. So, shareholders should be aware that, aside from their interests as shareholders, our sponsor and certain of our directors and officers have interests in the business combination that may conflict with those of other shareholders generally. Our directors were aware and considered these interests, among other matters, in evaluating the business combination and in recommending to shareholders that they approve the business combination. Shareholders should take these interests into account in deciding whether to approve the business combination. These interests include, among other things, the fact that certain of our directors and officers are principals of our sponsor, the fact that 6.5 odd million founder shares held directly by our sponsor, for which it paid $25,000 in aggregate, will convert into 6.5 odd million shares of new MAC ordinary shares upon closing, but will be worthless if an initial business combination is not consummated.
Okay, so that's saying that 70 million bucks will be given upon 70 million bucks worth of shares in the pro forma will be given upon successful acquisition of CSA in this state.
Yeah, the vote needs to be approved, the business combination occurs, and the sponsor emerges with with about 6.5 odd million shares in MAC. But if there's no vote, then it's a zero, it's sort of worthless position.
Okay, so what do we know about this Green Mountain then? So the sponsor. So let me actually just clarify the sequence of events here for me, lads. So this Green Mountain company, Green Mountain Metals company, has been created. That company then created a SPAC.
Well, they don't create it. It's the SPAC's a separate entity. The sponsor becomes a shareholder of the de-SPAC'd.
Then Metals Acquisition Corp was created at some point. This Green Mountain then says to Metals Acquisition Corp, here is a blank check. Go find me a mine. We want exposure to the upcoming copper boom.
Green Mountain doesn't dip into their own pocket for cash. Green Mountain is usually representative of some of the talent that will work for the SPAC, but they don't actually have to pay much. They, like in this case, it said they paid $25,000, right? But they get given, like for that $25,000, they end up with a pretty large percentage of the company upon a successful deal combination,
and they attract the initial investors.
Okay, and that $70 million worth of shares that go to Green Mountain, that is then given to the Green Mountain principals, office holders, or how do you term it?
Well, Green Mountain is a company that will, like, it's a bit behind the Cayman Island laws of how the ownership structure is there. We can infer some things from the details in the prospectus about who has some rights to, or some shareholding of that company, but yeah.
But they're the people that are making this deal happen. So instead of a company saying, right, let's employ an advisor and some finance firms to say, right, we need help to acquire a project. Instead of paying them all the money to help them, they get these individuals with good reputations and track records, and they pay them in these.
That's one of the ways
SPAC
it works.
Shares.
Yeah, and that's what
you're going to have to dumb
sponsor.
It down for us all here, boys.
JD's the best place one to dumb it down, I reckon.
Jeez, what's that, JD?
Having a go, I reckon.
You can work at my level, JD.
So to recap, I reckon we can see that Green Mountain Metals is the sponsor of this. We don't know who the directors or the actual shareholders of Green Mountain are. That's just a Cayman company. They paid $25,000. They got what is today roughly $70 million worth of shares, but they only get that upon completion of this deal. And you can see, reading through the prospectus, that there is some overlap between directors of Metals Acquisition Corp, MAC, and the officers or principals of Green Mountain Metals. So that's all we can sort of
surmise. There's like a signing execution block that lists members of Green Mountain Metals. I'm not sure if it's exhaustive or not, or if there's other shareholders of that entity, but you can get a pretty good read of some of the overlap that exists there.
So moving into the incentives, I think that's what we're kind of talking about here, and how they sort of lie between the sponsors and the shareholders in this company. We can sort of break down. We can do a Cynics versus Optimus. Cynic.
I think Trav will take the Cynic.
Yep.
Cynic.
I reckon that
round.
fits my cold heart.
Break it down for us.
So, I reckon a Cynic's take. A Cynic's take is that these SPAC structures, they result in these less than perfect alignment between management and new shareholders. And the incentives of a SPAC can sometimes lend themselves to getting the deal done at any price. And if that involves overpaying sometimes to get a deal done, then servicing the finance can be pretty tough on whoever's left holding the equity. And yeah, like additionally, I think you've got the sponsors who are pretty motivated by both time pressure and the payoff to actually see a deal done because obviously there's a ticking clock on when the redemption date occurs, and there's also like a payoff of either nothing or a fair bit if a deal completes.
But then they're incentivized by the fact that they're being paid in shares, not cash. So they wouldn't want to do a real shit deal because they then got the exposure to the share price if it does become under pressure.
Well, think of the average implied price of the shares going to the sponsor in this case. They paid 25 grand, they get 6.5 million shares. Even if Metals Acquisition Corp traded down 90%, then they're still up an enormous amount. So,
that's you could see. Can you see that as a fee for service, in a way?
Yeah, I think that lends itself to the optimist take.
Okay,
I think a shareholder who would have lost 90% of its money would struggle to justify that fee for service.
No, I mean the fee for service not in the case that it went down 90%. If it went down 90%, something's gone seriously wrong.
Yeah. Okay. So I think we could jump into seeing what an optimist would kind of see in this SPAC structure, and specifically as it relates to Metals Acquisition Corp.
Do you believe these optimistic statements, but JD, even though you're reading them?
There are some that I buy into. There's like Trav sort of touched, there are some incentives that are aligned, though they're far from perfectly aligned. But there are other signs an optimist would look for. You're getting access to a pretty, highly renowned team. So we know the team involved in this one, and as it goes with all SPACs, there have been quite reputable people and some less reputable people involved in SPACs, but just being able to do a deal with these, and the fact that a lot of these highly regarded people can work together on the same sort of deal because they can align their incentives.
So the SPAC structure, because there is this payoff concentrated to the sponsor, it actually can sometimes act as a bit of a talent magnet, and
exactly.
You get lots of talent all working together on the same thing.
Yeah, and as it sort of relates to
Did
Metals...
Trav just chime in on the optimism there? Good work, Trav. Very proud of you, Trav.
As it relates to Metals Acquisition Corp, the management has said that they reckon they can optimise this mine and run it a bit better. We've heard that story quite a bit, and maybe it'll hold up. Maybe the asset just doesn't sit right within Glencore and they can run it a bit better. And additionally, if you are just bullish on copper prices, that might be another reason to be optimistic about this company coming together.
Okay, so the funding, we probably rehashed before. Let's go over it again. So no one knows who's going to be tipping in to the Australian IPO yet. That's all yet to be determined because it still needs to be voted on by the MAC shareholders.
That's right.
Yet to be determined. Yeah.
Okay, so that's still up in there. So that'll be pretty exciting to see who is going to. And you said that's about $500 million.
Well, I reckon that'll still be determined.
Oh yeah, so that's where they said in the prospectus that US 250, but then there was
225. Yeah,
media saying 500. I think media will probably quote it in Australian dollars.
Think of what you might have to price that at as well, in order for it to be attractive to Australian investors. You can't, in this example, the PIPE transaction, we brought up the fact that some of the cornerstone investors participating in that are actually getting transferred some of these founder shares as an extra incentive, right? You can't do that when you come IPO on the ASX. That's all those shares are now ordinary shares in MAC. So the pricing of any IPO, I think, is going to be an important factor, especially benchmarking it against the PIPE investment price. It's got to be attractive enough for new equity to participate.
Yep, and so let's hash out why a SPAC is doing this, why a SPAC is going for CSA, and so if you say these all-star people got together a couple of years ago and said, right, let's start another company and let's work together to buy an asset. We'll just IPO an ASX company. But is doing it this way doesn't conflict with their existing roles in companies they already run? Is that why you would go down this route? Because you can get those people together without being a conflict to their existing companies? What's the reason for them using a SPAC or going down this SPAC route?
I think you go back to our cynics versus optimists take on that one.
There's obviously the fee they receive on successful completion.
The cynic is like, there's a big payoff that comes with a deal completion.
The company will also probably flag that the debt markets in the US are a bit deeper, and they could have, tapped that a bit better. That could also be argued when you actually look at where all the funding came from.
I think this, like, the broader question here is, like, as just an investor in public markets, you're always looking for opportunities where incentives can be maximally aligned. You want to be able to buy in at the same price as management. You want them to own enough shares that they care about the same thing as you. All of these things sort of matter. I think there are some pretty good examples where superstar mining guys they leverage their reputation and they get a new vehicle, and new equity has a chance to invest at the same price and on the same terms as those superstars. And I think that's an example of where you get pretty aligned incentives. I'm not convinced that the alignment of incentives is comparable to a SPAC where the sponsors, which are sometimes key members of management, are getting an entry price that's orders of magnitude cheaper than new equity.
Right, now just clarify again for me the funding for this. So the headline number was $1.1 billion US for the purchase of CSA, but you went through all the royalty streams, the delayed considerations, and so the upfront consideration, taking into account the fact that they're getting upfront money for these offtake agreements. So
yeah, so
upfront was what, $875?
Yeah, the way to think about it is $875 upfront plus $31 million in financing costs. So $906 million, which will be paid in the next couple of months to Glencore.
From MAC to Glencore.
Exactly. And MAC have got all that cash from various sources. They've got that through their senior debt. They've got that through their mezzanine debt. They've got that through their equity investments. They've got that through their pipe. All that Cisco and Sprott stuff that plays into there.
And whatever cash is left in the trust that isn't redeemed.
100%. That's how you get to that total. And we'll put up a great chart now on YouTube that really summarises that well.
Okay, so the acquisition price is covered. Now they're going to potentially come to Australia, and let's say hypothetically they get a lot of interest and raise 500 million bucks Aussie for this ASX IPO of Metals Acquisition Corp. So then that money will be there's a gutload of operational cash flow. Operating capital.
Yeah, that could be used for various things. Yeah, hopefully they wouldn't need any working capital at that point, but hypothetically there could be, consolidation of assets. It could be used to pay down that very high interest paying debt. There's a whole range of sources.
Potentially other acquisitions.
Yeah.
So,
75 million bucks of that raise goes to Glencore, and that triggers one of the deferred consideration pieces in US dollars.
Yeah.
You'd probably want to de-lever the company if you had new equity in the door. Maybe some of it is, a sell down as well of shareholders.
Or buy back some of those streams. There's a few ideas out there.
Okay, so they're investing these all-star crew are investing in the future prosperity of copper. So let's think about Cobar. You've got CSA, you've got the Peel mine around there. There's a lot of, and look, development.
It's not called the Peel mine. The company's called Peel.
Peel, yeah. Sorry. And then you've got, developer Woodlawn. So there's
Aurelia around there.
Yeah, Manuka's got some weird one.
Helix, I think, are in the area.
Yeah, so there's that New South Wales copper basin could be a little hotspot coming up in the future. As I said, one of the highest grade copper mines in the world, and you would imagine that they're going to put a bit of that Aussie IPO into some hard exploration for that area. A lot of existing infrastructure, and they'll be looking to find it a bit higher up than 1,750 metres. I guess it fits that blend of, this mightn't fit a big Glencore, but it might fit a smaller company that's willing to spend the money on exploration, and Northern Star did.
Exactly right. And so it's Mick McMullen, CEO, running the company, and reputable operator. Who knows how Glencore's run the mine? Mick might have a view that spend a bit of money on development, and that's going to lead to better cash flows over time as well. So maybe that's another use of funds in any future raise.
Yeah, this is going to be very exciting to keep a watch on, especially to see who's on the Aussie IPO register.
Well, that's the interesting. That's why this whole story is super relevant, right? Because we're not left with many copper names on the ASX, and we're excited by the prospect of having a new one join the listed tables over here. So, we're pretty interested.
And it gives a bit of a scope on these high net wealth people's views on what they think the future is going to be. Because if they're tipping money into these copper IPOs, they're obviously got the same. Will Mr. Ellison go in there maybe?